Standard Costing, Chapter 11. This is Part 2, and we're going to go over the overhead variances. Again, we're looking at a budget for one unit. And we're going to evaluate quantity standards and cost. And we've already talked about material and labor variances in Part 1, and now we're going to talk about overhead rate variance, efficiency variance, and budget variance and volume variance. We're going to do the same problem that we did in Part 1. So first, I always like, when I'm doing overhead, I like to start with looking at the total. So the total variance is going to be your actual fixed manufacturing overhead plus your actual variable manufacturing overhead times the actual hours times the units produced. And that gives you your actual overhead costs. Now, applied overhead is going to be your standard fixed manufacturing overhead allocated based on actuals plus our standard rate times the units produced times our standard hours gives us 26,400. Add that together and it tells us that our total amount we're going to get is we are under applied by 1,660. So that's what all four variances must total. So we'll start with our variable overhead variances. The variable overhead spending variance tells whether more or less was spent on variable overhead than expected for the hours worked. The formula is going to be the actual direct hours times the actual variable overhead rate minus the standard variable overhead rate. Now again, here's our formula, and now we'll put in our numbers. We're going to take our actual direct labor hours times the units produced, and that gives us our 880, and then we're going to take our actual variable manufacturing overhead rate minus our standard, which gives us 20 cents. So it says that we spent more than we should have, and it was $1,760, unfavorable. So it tells us our actual variable manufacturing costs were higher than expected. Now we're going to look at the variable overhead efficiency variance. It tells how much of total variable manufacturing overhead variance is due to using more or fewer hours of the allocation base than anticipated. Here's our formula. It's the standard variable overhead rate, and then we take our actual hours times the hours that we should have used based on the standard, which is actual units produced times the standard direct hours per units allowed. So here's our formula. Here's our numbers. We take $3, which is our standard, times 1,600 units times 5 point, those are actual hours, gives us our 880. And then we're going to take our 1,600 units times our standard, tells us we should have used 8,000 hours, which tells us that we're over by 800 hours, which means we are unfavorable, which tells us the direct labor hours were higher than the standard allows, which means they were less efficient. What is our total variable overhead? Unfavorable. Now let's look at the fixed overhead variances. We have our fixed overhead budget variance and our fixed overhead volume variance. So, also called fixed overhead spending variance, it measures the difference between actual fixed overhead costs incurred and budgeted fixed overhead. So, easy formula, just find your actual fixed manufacturing overhead and subtract it from the budgeted fixed manufacturing overhead. Those are fixed. Remember, we're only looking at the fixed portion. So let's look at our same problem. We take the actual fixed overhead, which they give us in the problem, which is nice, minus the budgeted fixed overhead, which they gave us in the problem, which is also nice, which means we have a favorable variance because we spent $500 less than we thought we were going to. So that's favorable. So we spent less than projected. Now we have our fixed overhead volume variance. It's going to be our budgeted fixed overhead times our standard direct labor hours per unit times actual usage times the standard fixed manufacturing overhead rate. Again, same problem. There's our formula. So we take our 94,000, which is our budgeted fixed overhead. Now the second part, they gave us the standard fixed manufacturing overhead allocated based on actuals, but I wanted to show you how you get that. You take your standard hours times the units produced times the standard fixed manufacturing overhead rate, and you get the 96,000, which is what they showed you in the problem, which tells us we spent 2,000 less, which means it's favorable. This was because production was higher than budgeted. So, in essence, measures the utilization of the fixed capacity costs. If production volume is greater than expected, then fixed overhead has been overallocated and the fixed overhead volume variance is favorable. If production volume is less than expected, then fixed overhead has been underallocated and the fixed overhead volume variance is unfavorable. I hope that helps. Okay, now let's take a look at our total overhead variance, and this is from part 1 also. So, for overhead, we said that we were underapplied by 1,600. So, we add up all of our variances, including our direct material and direct labor. So this is not, wait 1 second, let me change that. So that should say total variances. So our total material variance, our total direct labor variance, this we calculated in part 1. And now we're going to do all overhead balances and add them up. And if you notice, they equal the total. So, which is unfavorable. It's underapplied. So our total variance is 20,330. Now, advantages and disadvantages of using standards. Well, one of the advantages, it gives you cost benchmarks. It's useful in budgeting, motivational, and simplifies bookkeeping because you actually use the standards to book your journal entries. Now, the disadvantage is that you have to update them all the time, and you know that never happens. So there's lack of timeliness, focuses on operational performance measures and visual management, and unintended behavioral consequences. So there are it's the kind of thing you got to keep up with all the time. And that ends chapter 11. I hope that helps you with the homework because I actually went through the homework for you.